A lot of traders are struggling in the financial market looking for the perfect trading strategy that they can use to make money in the forex market. Honestly speaking, getting the perfect trading strategy has to do with backtesting. Through backtesting, you'll be able to get the perfect trading strategy. But in this video, I'm going to be sharing with you a powerful price action trading strategy. This is the only trading strategy that you will ever need. This is the only technical analysis that you will ever need. Once you are able to master this technical analysis, you'll be able to make money consistently in the forex market. This video is packed with so much valuable content. So my advice for you guys is to support this channel by subscribing to this channel. Subscribe, turn on the notification icon to be the first to be notified whenever I drop new video. So this video is going to tell you everything about technical analysis, most especially on price action, because that is what you need as an edge against the market. So once you master price action, you'll be able to make money consistently in the forex market. So I'm trying to teach you what I know and what I've implemented, which has been working for me for a very long time. So now these are the topics that we are going to cover in this video. And like I said, this is the only technical analysis video that you will ever need. Once you master it and backtest it, you will be able to make money consistently in the forex market. Now, these are the things we are going to treat in this video. So we have the first one, money and risk management, which has to do with your lot size, stop loss, and take profit. After that, we're going to talk about the market structure, which has to do with the uptrend, the downtrend, and the range. Then we also talk about the area of value, which has to do with support and resistance level. Then we also talk about the breakout from support and resistance. Then we'll talk about the bounce off from support and resistance. Then we also talk about the trend line, which is the diagonal support and resistance. Then we'll also talk about moving average, which is dynamic support and resistance. Then after that, we'll now round it up with our entry, which is bullish and bearish reversal candlestick pattern. So these are the things that we are going to treat in this video. So that is why I want you guys to pay clear attention. Once you get everything in this video, you will come out with an edge against the market. So you'll be able to trade profitably because you now have the weapon to fight the market. So what you can do for yourself is to make sure you watch this video from the beginning to the end. Do not skip any, because you are going to learn a lot from this video. Now let's start with money management. Whenever you're entering into the forex market, the first thing you need to consider is your risk, your money management, your ability to protect your capital. So these are the first thing you need to consider. So what is your capital? That is the number one thing you should ask yourself. What is your capital? If you have $10,000 as your capital, what are you willing to risk in a day? So in that $10,000, you are only allowed to risk at least 10% in a day. That is the amount of money you are only allowed to risk, 10% in a day. So once you lose that 10%, you close for the day. In that money, you are meant to risk just 1% per trade. So you risk 1% per trade and you risk 10% per day. So when you place the first trade, which is 1%, it will take you 10 times. So if you place 10 trades which amount to 10%, and you end up in a loss, please do yourself a favor, close for that day, continue the next day. That is the rule, 10% rule. So this will help to protect your capital from draining, and it also help your psychology. It will help you against revenge trading, just as most people normally do. Once they lose, they start doing revenge trading. So your money management, your risk management is very, very important. So now when we talk about the money management and the risk management, it has to do with your lot size, your stop loss, and your take profit. So what lot size do you want to use for your 10K account, right? So you need to make the calculation, because before you can arrive at your money management rule, you must have a fixed amount of money that you are willing to risk per trade, which will amount to 1% of your capital. And for the fact that your account is 10K, 1% of 10K is $100. So you have to look for a lot size with a stop loss that equal to $100. For instance, you can use a one standard lot size with 20 pips, which will amount to $100. Or you can use 0.5 lot size with 20 pips. So this is a private assignment that you can do. Just take our time and analyze it. Look for the lot size that will rhyme with your stop loss. Just make sure that once you make the calculation, let it amount to $100, which will be what you are willing to risk per trade, and you stick to your stop loss. So if your stop loss is 20 pips, make sure you stick to 20 pips stop loss. And once the market hits your stop loss, you are out. Do not shift your stop loss. Very, very important. So your stop loss must be fixed. If it's 20 pips, let it be 20 pips, right? And if it's 40 pips, let it be 40 pips. Don't ever shift your stop loss, right? Because through that, you have already calculated how much you are willing to risk per trade. So this is the first thing you need to consider. Then you have to have a fixed take profit, because the market is unpredictable. Because if you are too greedy that you have an unrealistic expectation, maybe you set your take profit to 1000 pips or 500 pips, and if the market doesn't get to your take profit, the market can reverse and come back to your entry, and you end up losing all the profit that you would have made. And also make sure that you have a fixed take profit, right? And do not shift your take profit. If your take profit is 50 pips, let it be 50 pips. If it's 100 pips, let it be 100 pips. So this is what will help to protect your capital no matter what. So after taking into consideration your risk and money management rule, the next thing you need to look into is the market structure. So we are going to look into the market structure, right? So we are done with the money and risk management, and we have talked about the lot size, your stop loss, and your take profit. So we are now going to look at the market structure, right? We look at the uptrend, downtrend, and range. So we'll now go to the price chart. So here, when you open the price chart, you have to look at the time frame that you are trading with, right? So we have different types of traders. We have the position traders, we have the swing traders, we have the day traders, and we have the scalpers. So it all depends on the kind of trader you are, right? So if you're a day trader, at least I think from 1 hour to 15-minute time frame should be your ideal time frame. While swing traders can use 4-hour and daily time frame, while position trader can use monthly, weekly, and even yearly time frame. So it depends on the kind of trader you are. But for this tutorial video, we are going to use the intraday trading strategy. So we're going to use the 1 hour time frame for this tutorial video. So we're going to use the 1 hour time frame, right? So this is the 1 hour time frame. So after you have done your money management calculation, the next thing you have to think of is look at the chart and the market you want to trade. So now if you go to the trading view, we have different markets. This is your watch list. So this is where you check for the market that you want to trade. We have gold, we have Euro USD, we have USD JPY, we have GBP USD. So this is the watch list where you can choose whatever market that you want to trade. So for this tutorial video, we're going to use gold, right? And we are using 1 hour time frame, but you can use any time frame that you want. This 1 hour time frame is just for this tutorial video, right? So now we have chosen our pair, which is gold, and we have chosen our time frame, which is the 1 hour time frame. So now the next thing we have to look into is the market structure, which has to do with uptrend, downtrend, and range. So if you look at this market, you clearly see that this market is in an uptrend, right? Gold is in an uptrend. So what we are going to use right now is we are going to use a trend line to confirm if truly gold is in an uptrend. So we'll simply plot out a trend line and connect the lows. So with the help of a trend line, we have confirmed that this market is clearly in an uptrend, right? So now that we have done the confirmation that the market is clearly in an uptrend, so what are we expected to do? We are expected to trade in the direction of the trend because the market is going up, so we are only looking to buy. So for the fact that we are looking to buy, we should be looking to buy from where? We should be looking to buy from the support level because the market is in an uptrend. So in an uptrend, the market always makes higher high and higher low, right? So this is the higher high, this is the higher low. Then we have another higher high here, and this higher low, another high, low, higher high, then we have low, another one. So this confirms that the market is clearly in an uptrend. So you can also use your trend line to make the confirmation. You can clearly see from here the market is clearly in an uptrend. You can clearly see with this, you can clearly see that the market is in an uptrend. Market is clearly in an uptrend. So once you have confirmed that the market is clearly in an uptrend, you should be looking to buy from the lows. That is where you should be looking to buy because the market is clearly in an uptrend. Your target should be from the lows. That is where you should be looking to buy. All right. So now if you look at this, you can clearly see that the market is making higher high and higher low, higher high and higher low. So this tells you that the market is clearly in an uptrend. So you are only looking to do what? To buy in this market. And for the fact you have drawn your trend line, you are waiting for the price to come to the trend line for you to take your buy trade. So if you watch, you see that as the buyers took over control, the price rallied up to this point, then came down here and made what? A pullback, made a retracement here. So this is the point where you are supposed to place a buy trade before the market now rallied up again to this point, right? So you are not expected to buy at this point because at this point the market has traveled too fast. So you have to exercise patience and wait for a pullback for you to be able to buy. So once the market makes a pullback to the trend line, you cannot take a buy trade, right? So with the help of the trend line, you can be able to buy from the pullback. So this is what we call the trend line bounce, because the price bounced up from the trend line. So in this scenario, the trend line is acting as a support level for us because each time price comes to the trend line, it bounces off from it. Each time price comes to the trend line, it bounces off from it. for that fact, the trend line is now acting as what? As a support level for us, right? So now you have looked at the market structure and you have confirmed that this is clearly an uptrend, so you are only looking to do what? To buy. So now if we go back to history, you can be able to spot another market structure. Now if you look at this one from here, you can see that the market from here is a downtrend, right? And for the fact that the market is in a downtrend, you are only looking to sell. So you simply use your trend line to confirm if truly the market is in a downtrend. So for the fact that the trend line is heading down, you can clearly see that the market is in a downtrend because the trend line is heading down. The market is clearly in a downtrend, right? In this scenario, the trend line is now acting as what? As a resistance level, right? So each time price comes to the trend line or very close to the trend line, you take a sell trade. Each time price comes very close to the trend line, you take a sell trade, right? So this is how you trade. You need to understand the market structure. Like in the uptrend, you can see that the buyers are in charge of the market. That is why the market is always going up, up, up. But here the sellers are in charge. That is why the market is always going down, 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 down. So you can clearly see that in a downtrend, you only sell, but in an uptrend, you only buy, right? So then we now look at the next one, which is a ranging market. So in a ranging market, the market is making ups and down. It's going up and coming down, going up and coming down, going up and coming down. That is why I call it a ranging market. So from here, from this point to this point, you can clearly see that the market is in a range before it finally broke out. So in a ranging market, you buy from the lows and you sell from the top. So once the market makes pull back to the low, you take a buy trade, and when price makes a rally to the highs, you take a sell trade. So you wait for price to come to the support, you take a buy trade, and you wait for price to come to the resistance level, you take a sell trade. So in this scenario, there is an equilibrium between buyers and sellers. So the buyers buy from the low, the sellers sell from the highs because the market is consolidating. So in this scenario, the buyers and sellers are exchanging price, right? But it's just a matter of time before one of them takes control of the market. Either the buyers or the sellers take control of the market. But in this scenario, the buyers took control of the market. So this is what we call the breakout of a resistance level, right? You can clearly see the breakout. The price finally broke above the resistance level and an uptrend began. So this is the new uptrend that just began. So after the breakout, the price came back again to retest the resistance level, right? And like I said in my previous videos, when a resistance level is broken, that resistance level automatically becomes what? A support level. So now that the price has broken above the resistance level, all you need is to exercise patience and wait for the price to make a retracement. No matter the distance that the price traveled, it will definitely come back to retest this level that was broken, right? So that is why in trading, patience is very, very important. You have to be patient to wait for your entry, right? Because if you have the FOMO in your mind, like you are the type of trader that is always chasing after trend, if the price breaks above this resistance level and start trading up, and maybe this is where the price is, and you decide to place a buy trade because you don't want to be left out, you don't want to miss the trend, the price can just go up a little and then start retracing. Before you know it, it will take you out, right? So that is why patience is always important. So as the price breaks above the resistance level, you exercise patience for the price to make a pullback to the resistance level. So once the price makes a pullback to test the resistance level, which has automatically become a support level, that is when you are expected to do what? To place a buy trade. So your buy trade should be here and your stop loss should be below the support level, the newly formed support level, right? So this is how you trade using pure price action. So we'll go to the second point here. The second point here is an area of value, which is what we have treated here. And like I said, an area of value can be support and resistance level, right? So in this scenario, if the market is clearly in a range, you can use the horizontal line to map your support and resistance level. Like now the market is in a range, you can use these lines, these two lines, as your area of value, right? So each time price comes here, you take a sell trade. Each time price comes here, you take a buy trade. But if the market is in a trend, like if the market is in a trend like this one, like you can clearly see that here the market is in a downtrend, right? So you can clearly see that sometimes the market doesn't come back to retest the resistance level. If you are drawing the horizontal level, like for instance, if you use this level as your resistance level, you can see that the market tested it once, twice, but the market was unable to test it the third times. So that is why you need a trend line, because when the market is clearly in a downtrend or in an uptrend, the market sometimes hardly tests the horizontal level of support and resistance. Rather, the trend line is what is required, because the market direction is according to the trend. If the market is going down, the market will just be heading down. If the market is going up, the market will just be going up. So the market is always finding it difficult to come back to retest the levels of support and resistance in case you are using this horizontal line. So that is why you need a trend line if the market is trending up or trending down, right? So that is why I said support and resistance level is very important in technical analysis. So this trend line acts as a diagonal support and resistance, which can be adjusted, because you have to be adjusting it as price breaks above it and returns back. You have to adjust the trend line, right? Let's say for instance the trend line is like this, right? And price broke above it and returned back. You have to do what? You have to adjust the trend line to make sure that the trend line is touching the upper wick, right? The upper wick. That is what makes a strong trend line, right? So you can clearly see here there is what we call trend line bounce. So each time price comes to the trend line, it bounces up from it. Each time price comes to the trend line, it bounces up from it. This tells you that the current market is downtrend until the trend line is broken before a new trend begins, right? So you can see that after the downtrend, the market now began to consolidate again, right? You can clearly see another consolidation. So this is another consolidation. The market consolidates again before a new trend began. So this is when you can use the horizontal levels, right? Because in this scenario the market is consolidating, so this is where you can use the horizontal level. So each time price makes a move to the resistance level, you take a sell trade, and each time price makes a move to the support level, you take a buy trade. So your stop loss must be above the resistance level if you are selling, and your stop loss must be below the support level if you are buying. And where will be your take profit? Your take profit will always be at the resistance level if you are buying, or at the support level if you are selling. So these are the things you should take into consideration. So for the fact that the market is ranging, trend line is worthless. We can't use trend line again because the market is in a range. So what works perfectly during a ranging market is this horizontal levels. That is what you use. So like I said, during a ranging market, you use the horizontal line instead of the trend line. So the trend line is only meant for the uptrend or downtrend. When the market is trending, that is when you can use the trend line. So you can use the trend line as an area of value, support or resistance level. So after that, there's another thing you can use as an area of value, which is the moving average. So aside from the trend line, you can also use the moving average as an area of value, which acts as a dynamic support and resistance level. So for you to be able to plot out the moving average, you can go to the indicator and then search for moving average exponential. This is it. You click on it once, right? Then it pops up. Then you go to the settings. You set it to the level that you want and the color that you want. So like I said, moving average works as a dynamic support and resistance. So you use it during a trending market, right? So when the market is trending up, the moving average acts as a support level because the price will always come to the moving average to test it before the uptrend continues. And if the market is in a downtrend, the moving average will act as a dynamic resistance level because in a downtrend, the price will always come up to the moving average to test it before the downtrend continues. So the same thing that the trend line is acting is the same thing that the moving average is acting. So the only difference between the both is that the moving average is dynamic. It is changing by itself. It follows the price wherever the price is going. But the trend line needs to be adjusted because it's a static. It's not moving. It's diagonal. It's something that is placed. It doesn't move, right? So it's something that you must be adjusting all the time. But moving average is dynamic. It follows the price wherever the price is going. So with the moving average, you don't have to do anything. What you have to do is just to watch the price. Each time price comes to the moving average, you take action, right? So you have to customize your moving average so that it fits the chart, right? So since the color is white, we are going to use blue. I think blue is okay. Then we increase the size a little bit. The size let it be a little bit big. Then we go to the input. Then depending on the period that you want to use, right? There are different periods. We have the 200 moving average, right? The 200 moving average is used by high time traders like swing traders and position traders and so on and so forth. So it helps us to know the high trend, right? The longest trend. That is why the 200 is there. We also have the 50 EMA and we also have the 20 EMA. So you choose the period that is okay for you. But for the sake of this tutorial video, we are going to use the 20 EMA, right? The 20 EMA suggests a strong trend, right? A strong trend. While the 50 EMA suggests a healthy trend, while the 200 EMA suggests a weak trend, right? So for the sake of this video tutorial, we are going to use the 20 EMA. So the length should be 20, then the method should be EMA, and then the length again should be 20. So here we are using the 20 EMA, right? So now the 20 EMA will be acting as support and resistance. But for the fact that the market current condition here is range, the EMA is worthless because you can see that the price is crossing and coming down, crossing and coming down. So you don't use it during a ranging market, just as you don't use a trend line during a ranging market. So once the market is in a range, you only use the horizontal line. This horizontal line is the perfect line that you need for a ranging market. It is only when the market is in an uptrend or downtrend that you can use the moving average or the trend line. So you can clearly see here we have plotted the moving average, but the price is crossing back and forth. Goes up, comes down, goes up, comes down, goes up, comes down, goes up, comes down, goes up, comes down. You can clearly see it. So if you are trading based on the moving average, you get so many whipsaw because in this scenario the market is just doing what? Consolidating. The market has no direction. It's just ranging, going up and coming down. So that is why the moving average in this scenario is not reliable, just as the trend line in this scenario is not reliable. So this is where the moving average can be reliable. Like here that the market is trending, the moving average can be reliable because you can see that when the price breaks below the moving average, in other words, we can call it the moving average crossover. The price came back, retested the moving average. You can see the price went all the way to test the trend line and then got rejected, forming this wick. So this is what we call a bearish engulfing pattern, right? So candlestick pattern can be used for what? For our entry. So once you identify the candlestick pattern at an area of value, because in this scenario the trend line and the moving average are acting as an area of value, you can now use the trend line as an area of value. But if you spot the candlestick pattern, the reversal candlestick pattern at the trend line, this tells you that the market is going up, and this forms your entry trigger. So this is what we call a bearish engulfing because the price engulfs below the green, so which signals a down momentum. So here the moving average is acting as a dynamic resistance level. That is why each time price comes down, it make a retracement to the moving average, and after testing the moving average, the price collapsed down. Right, you can see the price collapsed down, then comes back here again, tested the moving average again, and then collapsed down. So what you do is each time price comes to the moving average and forms what, a candlestick bearish reversal pattern, you take a sell trade, and your stop loss will be either above the moving average or above the trend line. So in this scenario, the moving average is acting as a dynamic resistance level because the market is in a downtrend. But if you come to this side where the market is heavily trending up, so here the market was heavily trending up, so here you can clearly see that the market is going up. So in this scenario, you can clearly see that the moving average is also acting as a dynamic support level because the market is going up. So each time the price goes below the moving average, it tends to receive support from the trend line. So combining a moving average and a trend line gives you a perfect trading setup, right? So that if price breaks below the moving average, it tends to receive support from the trend line. So where your stop loss will be is below the trend line, not below the moving average in this scenario, because you can clearly see that the price is breaking below the moving average. So this is the point where price began to respect the moving average after breaking below it here. So from here, the price began to respect the moving average from here. So this is the point where the price began to respect the moving average. But before, the price tends to break below the moving average a little, but the trend line acts as a reinforcement, as a support for it. So that is why combining the moving average along with the trend line is very important. It will give you a nice setup, right? So you can clearly see that the price is going up, up, up. So that is when the trend line and the moving average becomes active for you, right? But if the market is ranging, just like I've shown you, the moving average and the trend line is worthless, just like I've shown you. So if the market is ranging, the moving average and the trend line is worthless. Just here, you can clearly see that in this scenario too, the market is ranging from here. So you can clearly see that here the moving average is also not reliable because the price is just going up and down, going up and down, going up and down. So it goes up, comes down, goes up, comes down, right? So if you want a good setup, you should trade according to price action. If the price is in an uptrend, you use the trend line along with the moving average. So these two will act as an area of value, either an area of support or an area of resistance, depending on the direction. So if the market is in an uptrend, the moving average and the trend line will be acting as an area of what? Of support. So each time price comes down to the moving average or the trend line, you take a buy trade. And if the market is in a downtrend, the trend line and the moving average will be acting as what? As a resistance level. So that each time price comes to the trend line or the moving average, you take a sell trade, right? Then when the market now is consolidating, right, when you can clearly see the highs and the lows, you can now use the horizontal levels, right? In that scenario, the market has a point where it reverses on, which is the swing point. So if the market is ranging, the market reverses from the swing high and then reverse again from the swing low. So here is the swing high, here is the swing low. So if market comes to the swing high, it gets rejected, and if it comes to the swing low, it gets rejected. But if you use the trend line, you see that you get so many wrong signals. That is why you need to work with price action to know what is currently happening in the market right now, so as to be able to trade it profitably. So with this explanation, we have treated the support and resistance. We also treated the bounce off from support. So when we talk about this bounce off, the bounce off is when the price bounces off from the area of value. Like each time the price comes to the support level, it bounces off from it. Each time price comes to the support level, it bounces off from it. And each time price goes to the resistance level, it bounces off from it. Each time price goes to resistance level, it bounce. So this is what we call the bounce, support and resistance bounce. You need to understand this, right? Then we also have here the support and resistance breakout. Yes, the support and resistance breakout, right? So this is the breakout of the range, right? So here the market is currently ranging, and this is where we got the breakout. So after ranging for some time, the market finally breaks out, breaks above the resistance level, and an uptrend began. So as you are trading the bounce, you should also have consideration that the market can break out. So that is why your stop loss should always be there for you, so that if the market breaks out and hits your stop loss, you will know that the trend have changed direction, right? Then you can now reposition yourself, enter your trade at the right entry, and then you can be able to ride a new trend, right? So that is why you need to always pay attention to understand what the market is doing for you to take action. So we have treated the trend line, like the trend line acts as a diagonal support and resistance level. We have also treated the moving average, and like I said, the moving average acts as a dynamic support and resistance level. So let me give you another scenario for you to understand what I'm talking about. So when we talk about the entry trigger, we are looking at candlestick pattern, right? So the candlestick pattern will help us to know when to enter a trade. So if you look at this is what we call the hammer. This is a bullish reversal candlestick pattern, right? So once you see this hammer, it tells you that the price is still going up. So you are expected to take a buy trade after this hammer form at an area of value. So you can clearly see that the hammer is very close to the moving average, right? So you can see that the price makes a pullback to close to the moving average, then get rejected and formed this hammer. So this hammer acts as a bullish reversal pattern. So once this hammer closes, you can place a buy trade. Your stop loss will be below the moving average, and then you can be able to ride this trend, right? So this is how you can be able to trade the forex market profitably using pure price action with a good money management and risk management, because money management and risk management will always protect you from blowing your account or draining your capital. So this is how you trade the forex market, and this is how you analyze the forex market using price action technical analysis. So in this topic we covered money management, which has to do with lot size, stop loss, and take profit. So we talked about money management and risk management. So we talked about the lot size that you are expected to use, and the amount of money you are expected to risk per day, and the amount of money you are expected to risk per trade, which should amount to at least 1% and 10%. 1% per trade and 10% per day. Then we also looked at the market structure. So we look at the market structure because this is the first thing you should look into before you plan your trade. So the market structure has to do with uptrend, downtrend, and range. So you know when to trade, whether if you should enter or stay away. So if the market is in an uptrend, you know you are only meant to buy. If the market is in a downtrend, you know you are only meant to sell. And if the market is ranging, then you know that you are to buy and to sell. You buy from the resistance and you sell from the support. And you also watch out for breakout, because breakout tells you that either the buyers or the sellers have taken control of the market. Then we also look at the area of value. Before you place a trade, you must take it from an area of value. So that is why you need your tools like your horizontal line, your trend line, and your moving average. So these are the tools you use for your area of value. The horizontal line will act as a resistance or support level when the market is ranging. The trend line and the moving average will act as support and resistance level when the market is trending. So these are the tools you need for your area of value, right? So we have treated this very well. Then we'll talk about the breakout from support and resistance. So for the fact that the market is in a range and you have drawn your horizontal line at the top and the bottom, so each time price breaks above the resistance level, it means that the trend have changed direction, right? So you are meant to trade in the direction of the trend, right? And if the market is in a trending market like uptrend, the moving average and the trend line will also act as a support level for you. But if the price reverses and breaks below the trend line or breaks below the moving average, it means that the trend have changed to a downtrend and a breakout has happened. So you have to trade in the direction of the breakout, right? So the breakout can break through the trend line or through the moving average or through the horizontal levels, right? So these are the things that forms an area of value. They also talked of the bounce off from the support and resistance level. So the bounce off is when the price gets rejected from an area of value. Like if the market is ranging and you draw your support and resistance level using a horizontal line, if the market is going down, comes to the support level, get rejected and start heading up, you take a buy trade. So call it a bounce off. And if the market goes up to the resistance level, then reverse and start heading down, you take a sell trade. That's what we call it the bounce. But if the market is trending up, right? If the market is trending up, you know that when the market is in an uptrend, it always makes higher high and higher low. So all the time the market must make a retracement before the trend resumes or continue. So let's say the market is in an uptrend, the market will definitely make a pullback to the trend line, which is acting as a dynamic or diagonal support level. So the market must come down to the trend line or the moving average to test it before the uptrend continues, right? So that trend line is now acting as a support level. So each time price comes down or makes a retracement to the trend line and then reverse and start heading up, you take a buy trade. That's what we call a bounce off from the trend line or a bounce off from the moving average. The same thing is applicable if the market is in a downtrend. If the market is in a downtrend, the trend line or the moving average can also act as a dynamic resistance level. So when the price goes down, it will make a retracement, that is a pullback to the trend line, right? And once it gets to the trend line or the moving average, it will reverse and then start heading down. So once it reverses, you take a sell trade, but that's what we call a bounce. So each time price comes to an area of value, it will tend to reject, bounce off from it and start heading down. So with that scenario, it means that the current trend is still in progress until there is a breakout before we know that the trend have changed direction. So we also talk about the trend line and we talked about the moving average. Like I said, the trend line is a diagonal support and resistance. It doesn't change unless you have to adjust it by yourself. But the moving average is dynamic. It's a dynamic support and resistance. It changes all the time. It follows the market, it follows the price. So that one you don't need to do anything because that one changes by itself. But the trend line must be adjusted because each time price breaks below the trend line and then returns back, you have to adjust the trend line. Then we talked about the bullish reversal pattern where we use the hammer. So apart from that, in a downtrend, you can also use a bearish reversal like the shooting star. If the market makes a retracement to the resistance level, get rejected and forms a shooting star, you can take a sell trade. And if the market is in an uptrend, gets to an area of value like a support level, maybe it can be a trend line or a moving average, get rejected, forming a hammer, you can take a buy trade. Then you can also use the bullish engulfing. That is when the price is in an uptrend, makes a pullback to the trend line, and then another candle comes out and that candle becomes the opposite candle, right? Maybe the former candle was a red candle, the next candle becomes a green candle, and that green candle now engulfs above the red candle. It becomes a bullish engulfing. So that is where you are expected to take a buy trade. But if it's in a downtrend, right, and the market makes a pullback to the trend line or the moving average, which is now acting as a resistance level, and then ends up in a green. So the next candle that comes out now becomes a red, and that red drops and engulfs below the green. It is called a bearish engulfing pattern, which tells you that the sellers have taken control of the market. So with this, if you can be able to master this price action techniques, if you can be able to master this price action technical analysis, you'll be able to trade the market profitably. You'll be able to analyze the price chart, any price chart at all. You'll be able to analyze it perfectly. So this strategy can be used in any type of market, whether currency, whether future, crypto, binary option, stocks, indices, any type of market you can use it, because price action tends to work in all types of markets. So this is the only trading strategy that you need if you want to become a highly successful forex trader. This is the only technical analysis that you need. So once you master it very well, backtest it very well, and become an expert in it, that is a free road to financial independence. So that is all I have for you in today's video. I hope you love this video. If you do, give us a thumbs up. Don't forget to subscribe to my channel. Turn on the notification icon to be the first to be notified whenever I drop new content. I will see you again in my next update. Enjoy the rest of your day. Bye.